What is going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we're going to be doing an update on Tesla stock because the stock is reaching an all-time high right now. We are at $414 a share or a $1.3 trillion market cap. Now, if you don't know, Tesla has been, for the majority of the last decade, so about maybe a month ago or so, I sold it about $260, $280 a share or so. And because at that time, looking at the valuation, I said, okay, the forward PE is way too high on this stock, and the stock's going to come down at some point, and then I'll buy back in. So now, a couple months later, the stock is $414. And yeah, I missed out on a lot of money, but over the last, I mean, I bought the stock back in 2019 when it was a $30 billion company. And I pretty much sold some shares at the very peak back in 2021. And then I bought back in 2022, 2023, and then I sold those are the shares that I sold this past, couple months. So I made plenty of money on the stock, but yeah, I would have made a lot more if I would have held for these last couple months. But I still think I'm even more confident in my thesis that this stock is going to have a big drop pretty soon here, because when we go through the numbers here, you're going to see how high this valuation is. So, but I'm still bullish on Tesla long term and Elon Musk. I just think that the valuation is getting kind of ridiculous right now, and that people that are buying the stock at these crazy valuations of pretty much $1 trillion and over, it's just you're kind of playing with fire, because it's just too much gambling for me. I'd rather invest in something that has a stronger foundation as far as the company and the fundamentals go. So let's take a look at what the analysts have been doing for EPS. We have a $413 stock. And so for this year's earnings, you are paying 172 times earnings, which is insane. Okay. Then let's say we factor in next year's earnings, which is almost what they did last year. Then you're paying 127 times earnings. Okay. 127 times earnings. Keep in mind the general stock market trades at about 30 or so right now. And then we go ahead and look at the last couple of years of the valuation. And remember, we had a giant hype cycle and a giant, not a giant, but a pretty big bubble going on in 2021 when crypto and Tesla and all these other assets skyrocketed. And then what happened? We had a giant crash. And for the next year and a half, Tesla stock went all the way down, right? It went from $400 down to 100. So I'm not saying it's going to drop that much again, but I do think there's going to be a significant drop coming, because things look pretty similar to how they were in 2021. So then let's go to the Tesla P ratio here. The cheapest it's traded at is 34 times earnings, right? That's the cheapest. And that was near the bottom of our crash, or our bear market was 34 times. So I don't necessarily think it's going to go back to that valuation. That was kind of extreme. But as you can see, it generally, I mean, remember, this stock traded at 250, 350 times earnings before in a couple of years ago. But that was for a lot of other reasons. I would say the hype was probably more crazier back then. Tesla was just reaching profitability. Things were a little bit different. And now they're a little bit more of a stronger company fundamentally. So it's kind of a different story. But the point here is that the last 2.5 years, you can see that the P ratio generally likes to hang out around an maybe 75 or 80. Again, it fluctuates between 40 to, let's say, 80 or so, right? But somewhere in between there, so maybe around 60 or 70, that would probably be a fair valuation. Okay. And then not only that, but we're going to compare it to some other assets that have experienced similar stories, like Amazon and Shopify, both huge growth tech stocks. Amazon had a similar thing happen. It traded at insane valuations, 700 times earnings for a very short period of time, right? And again, when they're becoming profitable, that's generally when it is, because that's a big flip in the price, the valuation, the mentality around the stock, the sentiment, everything flips when the profitability kicks in. So again, though, it's very temporary. What happens? It drops big, and then over time, it goes further and further down to get to more and more realistic valuations, right? And so 2018, it traded at 75 times for a while, right? And then now we're at more realistic valuations, 45, 50 times earnings, right? So kind of condenses as time goes on. Same thing with Shopify. It's traded at ridiculous valuations, 500, 700 times earnings. I think at one point it was 1,200. I remember doing a video back in the day, and Shopify was 1,200 times earnings. So again, though, it lasts for a very short period of time, maybe a couple weeks, maybe a month or two. It happens, and then it crashes. Right? It crashes. It comes back down. Shopify is another one. It can trade at 50, 60 times earnings, and that's a little bit more reasonable for evaluation. As long as you're putting up strong growth numbers and you're growing at 30% or something like that, then it kind of can be justified. Okay. So there's two more examples of similar assets that had a huge crash like that. And that's why I was selling at that between $250 to $300 mark, because I mean, looking back now, yeah, it obviously ran up a lot more than that, but still the valuation was getting too high. And after I learned my lesson in 2021 with becoming greedy and playing with fire and waiting for the stocks to go up more, and the Cathie Wood stocks and all that stuff, you kind of once you lose a bunch of money, you'll get sick of losing money, and then you will learn your lesson through that experience. And then next time around, you're going to say, okay, I'm taking profits a little bit sooner, and I'll hold some shares. And if the stock wants to keep running up like how it is now, then that's fine. But this most recent time with Tesla, I did not do that. I literally sold every share I had. So that was probably my mistake. I should have held on to at least 5 shares or 10 shares or something, but whatever. I could do that next time. So now we're looking at this chart says 107, but how I just said, we're not at 107. We are at, for next year's earnings, we're trading at 130 times next year's earnings. So as you can see, it's starting to get kind of, I mean, it's past the point of being ridiculous now, to where there's no asset that needs to trade at 130 times forward earnings unless you are, at the beginning of profitability. But Tesla's not, that's not where this company, we're talking a $1 trillion, over $1 trillion company. If this is a company that's 10 billion or $30 billion and they just got the profitability, then yeah, sometimes it'll trade at 100, 150 times earnings because it just flips that way. But they didn't just flip the profitability. They've been profitable. This is a company that puts up billions of dollars of profit. And so there's just no reason for it to be trading like that. Revenue growth, 3% this year, 16% next year. That's not even that much. I mean, really, it should be trading at like 40 times, 45 times earnings. That's a fair valuation for the stock. But it's Tesla. It's the most popular stock. Elon Musk is very famous. Now he's associated with Trump. Tesla's just like the hottest stock in the market. It's been one of the hottest stocks in the market since 2020. Ever since it had its huge bull run, it's been like that. So then when a stock has more attention like that, then that's going to give it a little bit of a boost. It's going to be kind of like a bubble. So even with that being said, though, maybe 55, 60 times earnings we're talking here. This isn't, I mean, it's tough to justify it, but that's where this fair valuation is. So I still think this stock will come down to between 250 to 300. Let's say 275. When it comes down to 275 or so, then I'm going to be more than happy to start buying shares again. But until that point, the stock is just, you're playing with fire right now if you are buying the stock or you're thinking that it's going to keep running up. The other day, some analyst on TV said the stock was going to double from when it was 350. So he thinks it's going to nearly $700 a share. It's just ridiculous stuff like that. And back in the day when I was buying the stock originally in 2019, and the valuation was $30 billion, Morgan Stanley and a bunch of other firms had price targets of $10 on the stock. I'll never forget it. They didn't say it was going to zero. They said it's going to be a $10 stock, right? They pretty much said it's nothing. And they were all wrong, right? Pretty much everybody was wrong. There was only a couple people buying the stock. Cathie Wood was bullish. Ron Barron was bullish. A couple YouTubers were bullish, and me. And that was almost it. There wasn't many people buying the stock. Most people were selling it. Bill Gates, a bunch of other people had put options. It was at one point, Tesla was the most shorted stock in the market. And so we are far past that point. But moral of the story is the stock is insanely overvalued, and these bull runs don't last forever. Just like Bitcoin or something, it's similar to that. The stock's going to get cut in half or at least fall 30, 40% when some bad news comes out, or more. Right now, I don't think there's terrible news coming out for Tesla. They're doing pretty. The industry is pretty good right now. The problem is going to be just a stock market, an overall stock market correction, that's where it's going to pull the stock down 40%. So that is my analysis for Tesla. Thank you very much for watching, and I will see you in the next video.